My name is Jake. Welcome to the channel. I want to talk about the best high dividend ETFs. I want to share with you how you can think about this concept of trying to live off of your dividend portfolio and how high dividend ETFs can fit into your portfolio if your time horizon is the right fit. And I really tailor my videos and my content towards new and beginner investors. And the reason why I started this YouTube channel is it was really frustrating and challenging when I first started out because there was so much information out there, but I didn't really know what to make of it. And I was just lost. And so I want to break it down and make it as simple as I can. Once again, if you're new to the channel, my name is Jake. I retired at the age of 37 from my 9-to-5 job here in 2023. So I'm no longer working my sales job that I was working for 10 years. I'm now living off of my dividend portfolio. I'm not reinvesting my dividends, and I'm working on the side to generate a little bit more income to fill that gap from our expenses and what our dividend portfolio is providing. So that's a little bit about me. Now let me walk you through my methodology of selecting the best high dividend ETFs. So first thing that we're going to do is we're going to focus on an index. We're not going to go after any thematic like semiconductors or anything like that. There's no sector ETFs. It's just a broad-based ETF that covers all sectors. And the second thing here, and probably the most important, is I want to focus on low expenses, so low fees. And the next thing here is I only want to focus on market cap weighted indices so that it really follows the survival of the fittest. I love market cap weighted indices because over the long term, when you think in decades, you can't predict the winners. And so that's why I really like looking at those. The next thing here is I want to focus on total returns. This is the capital appreciation plus the dividend. So we're not just looking at one or the other. I want to look at a combination, but it's skewed a little bit more towards a higher dividend, but a focus on quality and total returns. And then lastly here, I want to focus on ETFs that have been around for a while, that you can back test them. You can see how they perform in bull and bear markets. And so we're looking at ETFs that have at least $1 billion in assets under management. And that's what we're going to take a look at. And in the words of the world according to Briggs,
got it, get it, good.
So the ETFs that we're going to take a look at today, the first one is going to be HDV. The second is going to be VYM. The third, DHS. The fourth, SCHD. And then at the end of the video, I'm going to do a side-by-side comparison. I'm going to stack rank them in terms of how they compare by their expense ratio, their dividend yield, their dividend growth, all of that good stuff that's important to dividend investors. Now, to make sure that we're all on the same page and we're talking about the same thing here, the way that I invest is using the core and satellite approach. Okay, where you have a core portfolio of high quality index funds. My preferred are SCHD and DGRO. That's your core portfolio where you overweight in SCHD and DGRO, regardless for the most part, your time horizon. Okay, and the percentage that you have in your core is anywhere from 70 to 80%. So the remaining 20 to 30% is what I like to call, or what are called, satellite positions. And a great satellite position is one that will balance out your portfolio based off of your goals. Does that make sense? So you're not blindly just picking and choosing at random, collecting Pokemon cards, right? Just at random, but you're being very selective, and the Pokemon cards, AKA the dividend stocks and ETFs, they're there to support your goals. Do you understand? And so this is what I talk a lot about on my channel. This is the simple path to wealth with dividend investing using the core and satellite approach to investing. Okay. And if that doesn't make sense because you've not seen my videos on this, at the end of the video, I will have a video pop up where you can watch that video next, where you can learn about the simple path to wealth. But it's very important that on my channel, this is what I talk about. I'm not talking about going all in on HDV, going all in on DHS, but that's how I'm approaching this video and this list. Now, I'm sure that there's a ton of you out there that are maybe new to this and didn't really fully understand what I just said. You probably think I'm speaking another language here. It's okay. I promise I'll try to make it so that everyone can follow along. But if you are a new dividend investor and you're trying to piece everything together, this video will really help you if you're looking to one day live off of your dividend portfolio. Because let's be honest, when you're a noob at something, you're going to make mistakes, and that's okay. And it's probably going to look a little like this.
Well, then I get all excited. I'm like Jojo, the idiot circus boy with a pretty new pet. The pet is my possible sale. Oh, my pretty little pet. I love you. So I stroke it, and I pet it, and I massage it, Yeah, I love it. I love my little naughty pet. You're naughty. And then I take my naughty pet and I go. Oh! I killed it! I killed my sale. That's when I blow it.
Oh my gosh. So first off, what I want to show you really quick is how you can do this yourself. I use Seeking Alpha for everything that I do, all of my research. I am an affiliate of Seeking Alpha. They're not promoting or sponsoring this video, but I really enjoy using them. If you want to support my channel and you want to sign up to Seeking Alpha Premium, you can use my link in the description below. You'll get the best pricing possible. They run regular campaigns where they give, coupon codes and free trials, stuff like that. You'll get the best possible price with my link. So really greatly appreciate it, but no pressure as always. So this is the screen that I use. And if you go on Seeking Alpha, you can go and you can create your own screens. You can save your own screens. This is the screen that I save. And what I like to do is when I'm searching for dividend stocks, generally what I'm doing is I'm focusing on a couple of things. I want to make sure that they're tax efficient. So I want to make sure that I'm only looking at US equities, right? So no international. I like looking at, ETFs that have a sizable amount of assets under management. I really like filtering for a low expense ratio. So the quant ratings, this is with the premium. So this is something that I generally use heavily is, how expensive are they? I don't even want to look at ETFs that have a high expense ratio. I just completely filter them out. Another thing that's unique about this list here, because we're talking in today's video about high dividend ETFs. And for me, a high dividend is anything that's really beating the S&P 500, which is right around 1.75% on average, historical average. I like looking at something that's double that, right? So around 3%, a 3% forward dividend yield. So if you were to invest today, you're getting a 3% dividend yield, but also more importantly, I like looking at ETFs that have averaged above a 3%. So if you're dollar cost averaging like I was my entire career, unless you have a lump sum amount of money, if you're dollar cost averaging from your day job, this is what you want to look at, this 4-year average yield. This is the yield that you can assume going forward because this is what you're going to get if you're dollar cost averaging. If you're going to lump sum invest, you got $10,000, this is what you want to look at. Okay, you got it? Okay, cool. And then this is another important thing as dividend investors, you want to make sure that your yield is growing. Even though they're a high dividend, I want to make sure that this dividend is still growing because inflation is a thing and eggs are still really expensive and Costco is going to bankrupt me because it's so dang expensive. Anyways, save that anger and frustration for another video. And this is the list that pops up. And then what I like to do is I like to filter by assets under management. And you can see here SCHD, VYM, DVY, HDV. So this is a list that meets my criteria. Has a low expense ratio, has growth, it has a high dividend. One thing that I want to make sure that you understand is we're talking about high dividend ETFs. So they're not going to have a high weighting in technology, right? And so if you have a 30-year time horizon, you don't want to invest into an ETF like this. You want to invest into growth. But if you have maybe 5 to 10 years before you plan on living off your dividend portfolio and your dollar cost averaging, it may not be a bad idea to consider adding a couple percentage points to your portfolio in one of these ETFs. In addition to SCHD, right? So SCHD, I'm assuming you're already loading up on that as your core, okay? But you'll want to notice technology at a very, very small percentage. This ETF, it has a total of 81 holdings and it is pretty top heavy where 51% are in the top 10 holdings. And you'll notice here in companies like IBM, Cisco, though Cisco's been doing pretty well recently, actually, Verizon, like some of these companies, they're not really going to 10x in the next couple of years. And so it's important that you understand that this ETF, it serves a purpose, and the purpose is not to double overnight, it's to provide a consistent income if you're looking for income. All right, now let's take a look at the index itself and see what it tracks. So this ETF from HDV, it tracks the Morningstar Dividend Yield Focus Index. So what is the Dividend Yield Focus Index? And really quick, I'm gonna go back here really quick. You can find this index under the summary page. So if you're looking at ETF, go into the summary page, scroll down and see which index the ETF tracks, because this is what you're going to get. The market is going to do what the market does, okay, Mr. Market, but the index will dictate how the ETF will be structured, and you as the investor, all you have to do is pick which index you want to invest in, okay? And they're all rule-based. They're not actively managed, they're rule-based, okay? So really, really important, and that's what makes them passive, okay? So the first thing that we're going to take a look at here for this index is that this index is looking at companies that are US-based and that they have a history of paying at least a dividend in the last 12 months. REITs are entirely excluded, so this will be 100% qualified. This is a qualified dividend, and they must rank in the 50% sector cohort of the Morningstar distance to default score. So this is a quality check that is proprietary to Morningstar. And they must have a narrow or a wide moat Morningstar economic moat rating. So I actually kind of like this because Morningstar, they're a research firm. They do all the research and they categorize investments based off of whether or not they have a moat. And, you know, we know from Warren Buffett, companies that have a moat have pricing power, are competitive. And then lastly here, you know, companies are ranked by the dividend yield, and the top 75 of this list are selected in this index. And the companies are weighted in the proportionate to the value of their dividend payments, and a 5% cap is placed on the weight of the individual companies. So you're not going to have companies in here that have over 5%. And if you see any company over 5%, once the ETF does a rebalance, it will trim out of here and reposition the capital into their other holdings based off of the target weighting. So that is how HDV is set up. Moving on to the next one here from Vanguard, VYM. This is the Vanguard High Dividend Yield Index. I invest into this ETF. This is one of my larger holdings in my portfolio. I've invested in this ETF for years. And so you notice here that also it has about a 10% weighting into technology. So this is not an ETF that is that's going to be 10xing tomorrow, okay? And it has over 450 total holdings and 25% in the top 10. And I like the percentage breakdown. It has companies in here like Home Depot, AbbVie, Pepsi, Procter & Gamble, a mixture. So I really like this index. And if we go over to ETF.com, I like ETF.com when it comes to the fund methodology, but essentially this index from VYM is tracking the FTS, the Financial Times Stock Exchange High Dividend Yield Index. And the index, what it does is it's focused on US companies and excludes REITs, and it market cap weights them. So the largest companies by market cap in this index will have the highest weighting. Okay, and then the ETF here, what they do is they rank companies by forecasted dividends over the next 12 months. I like that it's a little bit forward looking here in terms of the forecasted dividends, and those in the top half are selected into this index. And the stocks that make the cut, which are added, are weighted by market cap rather than dividends. This is different than a lot of other indices. Some indices weight it by dividends, but they're weighted by market cap. And then the result is that the portfolio will focus on the firm's size, the market cap, the yield, the sector exposure, and REITs are entirely excluded, which makes it 100% qualified. All right, moving on to the next one here, DHS. This is from Wisdom Tree. This is the US High Dividend Fund ETF. I like this ETF. I could see myself investing in it. I don't invest in it today, but I could definitely see myself investing in the future. I like that it pays a monthly dividend. It has lower exposure to technology at 7%. Energy and financials are the highest weighting in here. You're going to notice a trend, a lot of energy stocks in here. You got Exxon, you got AbbVie, Philip Morris, so some tobacco companies, some communication companies in AT&T, IBM. There's 381 holdings, about 40% in the top 10, which is a little bit heavier weighting in the top 10 here. And if you look at the fund methodology, you'll see here that the dividends are weighted annually and that they're weighted by the dividend. Okay, so the dividend that it's paying, and it's based off of the most recently declared dividend per share and adjusted by the company's composite risk score. But the composite risk score is an average of 3 factors, which is value, quality, and momentum. And they compare that score favorably on a composite risk score which will have an increase in weights, and companies that risk poorly will have a reduction in the weighting. So the higher the score, the more weighting. The lower the score, lower the weighting. Okay, it's rule-based. What you'll notice here with this one is that the maximum weighting can be at 5% and it's rebalanced annually. And if I go back here really quick, this was where it was at. So here we're almost at the end of the year, and it's not very many of them are over the 5%. Okay, but here, once it gets rebalanced, this will be capped at 5%, and the others will be redistributed, accordingly. And then the next thing here that I personally like is that no sector can be greater than 25%, and that real estate is capped at 5%. So this will be not 100% qualified, right? But it's going to be very, very close, where you see that real estate is at 5%. So this ETF would be 90. So like, say, for example, you got $100 in dividends, $95 would be classified as qualified, and $5 would be classified as ordinary. Okay, and that'll all be on your 1099 dividend form. If you use M1 Finance, for example, like I do, you'll get your 1099 dividend form at the end of the year. You upload it to TurboTax, or you send it to your accountant, and it's taken care of for you. You don't have to do anything. So I personally like that. I like that there's only a small percentage in REITs. All right, the last ETF is SCHD. This is the Schwab US Dividend ETF. This is my favorite ETF in terms of full disclosure. This is one of the largest holdings in my portfolio. When you look at the sector breakdown, you'll notice that there's a little bit more in technology, a little bit more in industrials, less in energy. So this is a big difference between the others, as less in energy, so a little bit more in growth. Healthcare, financials, consumer defensive, industrials, there's a little bit more growth potential in those sectors, and I personally like that. And you notice here that it has 40% in the top 10 holdings, 104 holdings. And, I'm a huge fan of this index. When you look at this, regardless if SCHD is up or down, these are the top 100 US dividend companies in America. And so if you ever see a video or hear somebody talking poorly, like, oh, SCHD is out of favor, it's going to, like, you have to understand that the market works in cycles. Not everything is going to outperform every single year. That's just not how it works. If SCHD is down and you're dollar cost averaging and you're getting a higher yield on cost today than you were yesterday, it should put a smile on your face. Everyone dollar cost averaging into their portfolio into SCHD should be thankful for every day that they get to buy. It's a gift, really. That's how I view it. Anyway, so when you look at the index here, this is from the S&P Global, the Dow Jones US Dividend 100 Index. It focuses on the US market and excludes REITs. And there's a focus on 10 years of dividend payments. This is the official index, and it looks like, something out of a dissertation, right? So this is kind of the index as a whole. If we kind of dumb it down for me, the way that it's set up is the SHD focuses on companies that have 10 years of history of paying dividends, an increasing dividend, and that it screens for cash flow to debt ratios, return of equity, dividend yield, dividend growth rates, and the objective is to focus on quality companies with sustainable dividends. As such, this approach gives the fund modest large cap tilt and excludes REITs entirely. Individual securities are capped at 4%, and sectors are capped at 25% of the portfolio. Its overall composition is reviewed annually, while the portfolio is rebalanced quarterly. So you're not going to get a lot of companies, individual companies in here getting overly weighted, because it is rebalanced quarterly. All right, now let's take a look at all four of them side by side. We got HDV, VYM, SHD, and DHS. You'll notice here that they've all been around for over 10 years. So when we backtest it, we'll be able to see good data around their performance. All very low expense ratios, with kind of the exception of DHS. Okay, assets under management more skewed in these, obviously, than DHS. It's a little bit, Wisdom Tree's not as popular as Schwab or, Vanguard or BlackRock in this case. Okay, so if we go and we take a look at the last 10 years of historical performance, this is just the price return without the dividend reinvested. Without the dividend reinvested, SCHD is going to be the top performer. If we look at the total return over the last 10 years, you'll notice that SCHD is still, once again, the highest performer, with the lowest performer being DHS. This is why, one of the reasons why I say the simple path to wealth with dividend investing is to have a core portfolio of SCHD and not other ETFs like DHS or VYM or HDV. Like, really, SCHD and DGRO, in my opinion, are some of the highest quality ETFs out there that you can buy. And it's great to balance for almost every time horizon. And if we scroll down here and we look at the ETF grades, you can see that they all get pretty good ETF grades from Seeking Alpha. Some of the things that I really like to look at are, what are their expenses, the dividend grades, the risks, the liquidity. The liquidity is just, the assets under management, not really crazy. So I don't really care too much about liquidity or momentum. As a dividend investor, as a buy and hold investor, I really focus on the dividends and the expenses. When looking at the dividends, you can see that the trailing dividend, the highest here is going to be DHS, followed by HDV, and then SHD and VYM. But this is what you want to look at if you have, if you're dollar cost averaging, this is what you want to focus on, is the 4-year average dividend yield. And then the dividend growth, this is what's really impressive, is that, the CAGRs on the dividends, these are really, they're high dividends, but they're still growing 5+% every single year. And then scrolling down here, the next thing that's important I like to look at is the number of holdings. You can compare them here, the total number in the top 10. So this is how diversified the ETF is. And then the turnover, VYM is not looking so bad, actually. VYM is looking pretty good. And you can see that here in the turnover. So these for me are the best high dividend ETFs that are available today. In my opinion, like I said at the beginning of the video, really your focus, if you're building a dividend portfolio, it should be around SCHD and DGRO, and then you balance out your dividend yield and your growth rates based off of your time horizon and your goals. And these ETFs here, like VYM, HDV, or DHS, can be great options to choose from when trying to round out your portfolio if you're looking for a higher, more conservative yield. In my video from last week, I talked about the best covered call ETFs. Those are not as tax efficient. These ETFs here, these are much more tax efficient, and they may be more appropriate for somebody that has maybe a higher net worth, or somebody that is, dollar cost averaging into their portfolio, and they have a handful of years, maybe 5 or 10 years before they plan on reaching, early retirement. And I've talked a lot about the simple path to wealth with dividend investing in this video. And if you're new to my channel, you've not seen that video, I will have at the end of this video, that video pop up on the screen, and you can watch that video next. Thanks everybody for watching, and I'll see everyone in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.